Hello and welcome to our special series, Know Your Debt Fund. I'm Sumaira Abidi. Today we'll explore another debt fund category, the mighty liquid funds. Liquid funds are a giant amongst mutual fund categories, easily commanding pretty close to a quarter of the assets under management of the entire industry. So it's correct to say that of the over 22 lakh crore rupees being currently managed by the Indian mutual fund industry, about 3.3 lakh crore rupees are deployed into mutual funds, into liquid funds. So liquid funds, as the name suggests, are short-term funds which should be liquid or they should be easily accessible at any given point of time. This means that quality of the underlying is of paramount importance because only that can ensure that ready buyers are available at any point in time. So the fund cannot afford to take credit risk by investing in lower grade paper, as they are also less sensitive to interest rates. Now, as safe as liquid funds are, or rather they should be, this category has seen a few instances of negative returns as well, something which I'm told is a pretty rare phenomena. And, we saw this for the first time in, say, 2001 at the time of the September 11 attacks in the US. We saw this again in 2008 amidst the global financial crisis. In 2013, during the taper tantrum days in the US, and recently we saw it earlier this year as well in March. But here's where it gets intriguing, because in all the past instances, the negative returns have only lasted for a single day, but in March we actually saw 3 consecutive days of negative returns in some schemes. A peculiarity also of the liquid fund is that as a category it is heavily used by institutional investors, which means that large corporates or HNIs and they withdraw large amounts. They also add large amounts almost simultaneously because it's geared either towards a quarter end or a month end. So what place does a fund like this, a liquid fund, have in a retail investor's portfolio? What exactly is this giant that we call the liquid fund? How does it operate? And what does it add or take away from your portfolio? Joining in to answer all of these questions this afternoon, we have Feroze Azeez, Deputy CEO of Anand Rathi Private Wealth Management. Hi, Feroze. Thanks much for joining in. The liquid fund is a really large category, right? Nearly a quarter of the AUM is in the liquid category, but they're also prone, to quarter-end, month-end volatility. So is that a worry at all for retail investors? Or would you say that because of the introduction of the graded exit load, things have become, much more smoother?
Yes, I think, Sumaira, firstly, like you rightly pointed out, there is a lot of volatility in the assets these liquid funds manage. It goes up and comes down very sporadically, depending on the market's liquidity situation. Because this platform is being shared by institutions and retail at the same time. This is one of the schemes where there's an intersection of the audience or the investor category, which is very different in terms of risk return profile. So point one, yes, the assets are very volatile. Point two, does it worry a retail investor too much? It shouldn't, especially after the graded exit load, which you rightly pointed out. Quite a few corporates have moved their money from liquid funds to overnight funds, where there's no exit load whatsoever. So that piece of very volatile assets has been moved to another category, leaving liquid funds at least like a 10-day, 15-day investment. Otherwise, corporates would invest in these liquid funds over a weekend and take it away beginning next week. So that I think that very, very fluid money has moved to another category called overnight fund. So you're right, but because of the graded exit load introduction in October last year, this has become a little more smoother curve. Of course, last March has been an aberration where 20% of the assets in the last quarter were lost. Because of course, the pandemic and the need of liquidity across corporates.
Okay. Feroze, also, there is this whole phenomena, right, of this whole the quarter ending surge in liquid funds assets. So if we can pull up the plate of, the assets that they are managing and the quarter-on-quarter comparison, we always end up seeing that it's the first quarter that generally has the bulk of the money coming in. Is that right?
Yes, I think what happens is during the previous quarter, which is the quarter 4, quite a few corporates want their balance sheets to reflect in a specific way. So a lot of money moves from one cash equivalent asset to another. So quarter four is a bad quarter for liquid funds. Quarter one of a financial year is generally good. So that trend clearly comes out. I hope this year also the trend continues, but looks unlikely given the kind of liquidity crisis we will have because of the lockdown and so on and so forth. So you're right, Sumaira, that's a clearly defined trend that the first quarter of a financial year is a good quarter for liquid funds.
Feroze, where do returns figure over here? Now, is that a factor at all in when an investor is deciding the scheme?
Yes, return is definitely a very important factor. But having said which, you have to take the statement with a pinch of salt because return of the past is not so clearly correlated to the future performance. So return is of course important, but apart from that, yield, which is nothing but a future projection of the scheme's return, is even more important. If you look at the last 5 years return of liquid funds, it could be upwards of 7.5%. But if a person, a retail investor especially, if he buys a liquid fund with that expectation, he or she would be disappointed. Because what's more important is the yield. Because it's a 1 month, 2 month kind of an investment. What is the yield in the portfolio becomes the most important criteria. So yield currently, to my mind, could hover around 4.4 to 4.5 to 5% in most of the liquid fund portfolios.
Okay, and essentially, like the graphic is pointing out, between the best and the worst fund, the difference in yield the difference in return could actually be between 1.5 to 2.5%. So I guess every time you choose a scheme, it does matter. Feroze, as rare as it may be, we've seen instances of liquid schemes giving negative returns, right? In March alone, we've seen 3 days of negative returns. Would liquid funds still be considered a part of the safe bucket for retail investors?
I think so, Sumaira. 3 days of liquid funds giving negative return impacts the corporates massively because they're investing thousands of crores. For a retail investor, if he sees no return for 3 days and in fact sees a marginal drop in the NAV, which is definitely minuscule in nature, so it should not worry a retail investor, to my mind, because if you're investing 1,000 crores as a corporate, you want to earn every day and you don't want to even miss out the return of 3-4 days. So that shouldn't worry. And in fact, this time the situation was far more extreme. Far extreme than it was in 2000 and 2008 and 2001. In spite of a large regulatory change on the way these portfolios are constructed and valued, you still see a larger dent in the NAV. If we go back in time and see what the avatar of 2008 liquid funds were and then extrapolated what it would be like to have that fund during the pandemic, and then the negative returns could have been as much as 10-15 days. So since there has been a lot of regulatory change in terms of what you can buy as a fund manager, what you can't buy, how can you value, is why you see just a 3-day dent. But the situation in the last quarter was extreme enough that it could have shown a 10-15 day negative return if not for the prudent regulatory framework by SEBI.
So what you're saying is that, compared, the lessons of 2008 basically have been learned and implemented. So therefore, for now at least, it's the best framework that liquid funds could have had.
Absolutely, Sumaira. I think it has only a 1/3 of the portfolio which is mark to market greater than 1 month. The rest of it is all on accrual basis, by which I mean any change in interest rates does not impact almost 2/3 of the liquid funds portfolio. So whatever impact has to come because of change in interest rate has to come because of 1/3 of the portfolio. So I think I endorse what you just said. It is the most investor friendly and lesser volatile regulatory framework in terms of construct, credit risk, and also in terms of valuing it for a person to buy and sell.
Okay, Feroze, we have a query from Twitter. Jay Shan has written in. He wants to know that liquid funds should be for short term or for a period of 91 days alone. And he wants to know, are liquid funds tax free? So that will also bring us to our next topic about the taxation on liquid funds.
The time frame to invest in a liquid fund, to my mind, ideal could be 15-day to a 3-month period. So it does not necessarily have to be a 90-day investment. In fact, corporates were using it for a couple of days, is why the graded exit loads, which Sumaira highlighted, you highlighted rightly. So to answer your pointed question, Jayshawn, it is 15 days to 90 days kind of an investment time frame. Are they tax-free? How we wish, but they're not tax-free. They are, if you redeem and if you've got it in the form of dividend, then there is a specific taxation to it. But I think you can generally choose a growth option where you get capital gains and short-term capital gain or long-term capital gain. So it's not tax-free to answer your question.
Feroze, there's so much risk aversion currently with regards to debt funds. Is it really worth a retail investor's time and energy to look at, a liquid fund right now? Why not an FD? And, what's the yield likely to average, say, in the near term, the next 3 months?
See, I think that's precisely the kind of risk aversion and the environment we are in is why you need a liquid funds understanding more so today than ever. Because a liquid fund is one of the, if not the least risk mutual fund offering. It is one of the least risk mutual fund offering because it buys paper which are very strong, very short in maturity, very well diversified. So I think it's very important to not just look at fixed deposits, because you will do fixed deposits in one specific bank. You see several retail investors buying fixed deposit from cooperative banks, which have shown several defaults and time and again. So liquid fund is something which one should have, and more so today, and have only one liquid fund. So the point to remember is don't have multiple liquid funds. Have one liquid fund for a life almost. So I use the same liquid fund folio for the last 12 years. So you don't need too many liquid funds. It's like a replacement to a bank account, which is more diversified than one bank. So I would say liquid funds are on par with fixed deposit, or in certain cases, depending on the banks, which bank we are speaking about, they could be significantly better in terms of risk profile, being lower in a liquid fund.
Feroze, who exactly is the category of investor who should look at investing in a liquid fund? I mean, who needs it?
See, I think all human beings need it who have some money. So point is, it is good for corporates. Anybody who has surplus money for even 5 days, 10 days, 20 days, or anything more than 10 days, which most of us end up having, and a reasonable amount of money, not a couple of thousand rupees, a lakh and above. If you have 1 lakh rupees surplus ever for 10 days, 15 days, which most of us would have at a point in time, liquid fund is meant for them. And I think it's a temporary parking. Temporary parkings may not be relevant at the current situation, like a pandemic where you have used up most of your savings bank account balances. So it's meant for everybody. And I think everybody should understand it. The unfortunate part, Sumaira, is people buy and sell things for years without understanding them. Now, if you ask anybody who's a liquid fund investor, what is the underlying security inside it? Whether it's a commercial paper, what is a commercial paper? So what is a certificate of deposit? So people generally should dig deep into something which is going to be a part of their lives forever and understand what are each instrument categories inside it as well.
Fair enough. Feroze, in terms of, which instrument would a liquid fund be closest to in terms of, its profile, and how would a liquid fund stack up against, for the lack of a better word, its nearest competition?
Yes, I think, Sumaira, I think the closest competitor over the last decade for a liquid fund has been an arbitrage fund. They've been doing their jugalbandi. Sometimes this is better. Sometimes this one, the arbitrage fund takes over the performance, post-tax performance of liquid funds and vice versa. So I think the devil is in the detail. In terms of which is better, it is more so decided on the basis of the current, the status of the investor, the tax status of the investor. If a person is in the lowest tax bracket, an arbitrage fund is out of the window. If you're in the highest tax bracket, arbitrage fund has immense merit because that fund is taxed on the assumption that it is an equity fund. So the tax is going to be long-term capital gain only at 10% and short-term at 15%. And most of these investments happen in the short term. You're not holding an arbitrage fund or a liquid fund for a year or 3 years respectively. So So short-term taxation on arbitrage fund is 15%. And on a liquid fund is marginal tax rate. So if a person is in the 30% bracket, there's a reasonable differential in the tax treatment. So point is, both are good. Which one is good for you depends on the tax status. And if you're in the highest tax bracket, an arbitrage fund is definitely worth considering. If you're in the lowest tax bracket this financial year, then definitely a liquid fund would beat an arbitrage fund on a tax basis. Having said which, one more point to remember, Sumaira, I'll just highlight. In the current situation where equity side is making losses, equity portfolios are making losses, you may just be able to get the equity loss to cancel out the gains of liquid funds under the capital gain head. So please also try and carry forward or use the losses on the equity side to set off your liquid fund tax liabilities because they are offsettable.
And Feroze, it's not fair that we've spoken about arbitrage funds but not explained it. So just quickly, for the benefit of our viewers, what is an arbitrage fund?
I'll try and explain that. Our arbitrage fund is a quasi-equity fund in terms of construct, but in terms of risk-return profile, it is more so like a debt fund. What it means is, in an arbitrage fund, a fund manager buys a share. Of course, that's not safe. That's not as safe as it could be. He or she, the fund manager, also sells the share in a futures market. So you're buying the same commodity and contracting to sell the same commodity at a future date. So if I buy a pen and also contract to sell the pen after 1 month, if I'm contracting to sell it, then I've bought a pen and I also have a contract to sell it. So that's why it's called an arbitrage. Locks in the price differential between the cash market and the futures market. Seems a little more complicated, but it brings down the risk by buying a commodity and contracting to sell the same commodity at a future date. So both the contracts are executed on the same day. Are at least entered into on the same day, hence locking in the differential price. And this phenomena is called arbitrage. As the name suggests, you're buying and selling the same commodity. In turn, the risk is lower, tax is more efficient. Sumaira, if that explains.
All right, and it's treated like an equity fund really with respect to taxation. So let's wrap up then, Feroze, quickly. A fund that you want to recommend from the liquid category for our viewers?
Yeah, I think an SBI liquid fund is certainly something which you should look at because it has a good yield of 4.8% and it has a low cost of 0.13% per annum, both of these numbers. So an SBI liquid fund you can stick on to for years and you will not need to monitor it too much.
All right, Feroze, thanks very much for joining in and for explaining this concept.